So today we got new all-time highs in the S&P 500, in the Dow Jones Industrial Average, and in the Nasdaq Composite, but not in the Russell 2000. There's some other asset classes that are kind of mimicking the weakness we're seeing in the small cap index. I'm going to break down what those are, how that impacts our sentiment, and what do we do? How do we trade when we feel like the market is overbought? Do we have to go against the trend? Do we have to dial things way back? Do we have to go to cash? How do we handle an environment where we're strongly bullish, but the trend is mature, versus when we're strongly bullish and the trend is just starting? So I'm going to break all that down with another trade example idea in an area that's showing some renewed strength this past couple days. Let's go ahead and get started. So today is November the 8th, 2017. This is the Market Outlook video. My name is David Settle. Thank you all for watching tonight. Welcome to our video. Welcome to those that are watching for the first time. If it's been a few weeks since we've been together, welcome back. I'm back here this week. Glad to be doing these types of videos again with you. Follow me on Twitter, go to my Twitter handle at DavidSettle42 for now. That's my Twitter handle for now. Follow me there. You'll see that I'm posting things throughout the day as well. I'll start getting more into the groove on that. You'll see that the market forecast you see a little graphic here. The market forecast tweet is usually pinned to the top. We hit 75 likes on the video last night. Let me know that you found the video useful by hitting that heart. I got the arrow pointing to the heart. And then if you would recommend that others should watch it, hit that retweet, that other button over there, and then Twitter can promote it to people that they feel would like that kind of content. So do those two things for me. Also on the YouTube channel, down below the video, you can see subscribe to the video first, and then there's that little bell after you subscribe to my channel. There's that little bell next to that. That will give you notifications through email. You can also even set up your phone to get text notifications when the video is posted to YouTube. But also on that, you can see that thumbs up. Click that thumbs up while you're watching this video. Tell me what you thought about the video in one click, and in the comment section, tell me something you learned from the video, so I can kind of see what works and what doesn't, and what you're picking up day in and day out on these videos. Also, one more quick thing before we get started: the survey. We hit 600. We're just about at 600 surveys. That's quite the number, way more than we expected, but there's still a lot of you I've noticed that haven't filled it out yet. So if you got a few minutes, it's only 8 questions. We appreciate your input. We're trying to start something new. We're trying to start something that just rocks and is everything that you want and need it to be, but we need your input to know what that is. So fill that out. The link again is in the description down below here on the YouTube channel. Look in the description. You'll see a link, first of all, to my email newsletter, and then so join that, but also a link to that survey as well. Click on that. Few minutes. Let me know if there's any issues with the comment. If they have any issues with it, with a comment down there on the YouTube page. All right, well, let's take a look at the S&P 500 first and get started. We'll look at the market forecast, of course, and you see the intermediate posture still strongly bullish, so nothing's changed there. Even, we've had some ups and downs. We had a little bit of a range yesterday with a spinning top. Today's range stuck in the middle of that. You'll see that here better in a minute. So because of that, we rallied, so that's why the momentum line came up off a low point, close to 20. But we didn't rally, enough, and that's why the near-term line came down, because again, we're still inside yesterday's range. So the near-term line showing some weakness. It's still above 50, and it's been above 50 now for 9 days. So it's getting a little long in the tooth. Remember, we're coming off of a period where we were like 20 days up above 50. This extended period here from that green circle to that red circle, that's one near-term rally. That's a very, very long rally in terms of typical time frames for the near-term line, which, like we mentioned before, is about 7 to 10 days, 7 to 12 days. 10 kind of in that midpoint. So, and so now we're, you can see green line to blue line. This is kind of a typical move. Here's the one before that produced that near-term pullback, and so again, we don't have to move up any lines because we didn't get to a new high. And you can see where the pullbacks will be. And I've mentioned this before, the 38% pullbacks at that near-term high point on the near-term pullback. And then, of course, the 23% Fibonacci retracement is going to be in this area where that low point is here. that near-term low point. And of course, the 50% Fibonacci is going to be around that near-term low here in that old peak. And then the 62 is still lining up with the last intermediate high point, the last time the intermediate low before we produce that low, and really the last market sentiment, the last time the market sentiment peak too, because that was a deep enough drop in intermediate posture that we had market sentiment line come down. Didn't come down very much. It got below 70, but it still came down and produced now this rally here that we've had for going on the last few months. A lot of this tax reform related. Again, a lot of the rally we've had since the election really has been based on hopes that fiscal reform, fiscal policies will help spur business growth and GDP growth. Monetary policy is kind of obviously has been used up and now is actually starting to be tapered in terms of raising interest rates and in terms of tapering down the balance sheet. So can't count on monetary policy to continue to push the market higher. So the market shifted its gears towards fiscal policies, hopeful fiscal policies, to keep the sentiment there. Because again, all a market is a marketplace of buyers and sellers. So something's got to keep the buyers coming. Valuations, earnings. I mean, there are some earnings growth that's been doing well. That should reflect itself in economic growth. Economic growth is still around 2%. So I mean, that's not what's driving, stocks of such high, lofty valuations. It's still this positive sentiment that's being reflected in a lot of the sentiment-type surveys, economic indicators, that once, these fiscal policies get enacted, then that will have a positive effect on companies and their bottom lines and bringing that down. So we're pricing in a lot that we haven't got yet. But that doesn't mean that it's like, okay, well, this is all a house of cards and we should just now short this, because if that were the case, we could have shorted a lot of this, because we haven't had any of those fiscal policies enacted for a year now since the election. But the trend's still bullish. We're just showing some signs of weakness, and it doesn't mean we can't ride the trend. With some of our portfolio, with smaller position sizes, with less riskier type positions, less speculative directional type positions, more non-directional, safe, higher probability type positions. Those are the kind of trades we look for when we've been bullish for a long time, and when market sentiment's high, when we're multiple months into an intermediate trend. I mean, I don't know how many times we've taught, new students would come in to my former employer in a situation like this and start trading the method that was taught to them for trend trading stocks, and they'll start. Just coincidentally, they would start on a day in an environment where it's like this: high market sentiment, maturing intermediate posture, in this case, maturing near-term posture as well. And so we think, okay, well, man, look how bullish things have been, and we can find all sorts of examples of when that strategy worked along here because trend's been bullish, but we can't go back and trade any of that. We have to trade right here, and again, how if we had to put odds on whether by the end of the year we'd be down, say here in this area, Fibonacci support, or whether we'd be up to even higher highs. The odds are, simply because of how high market sentiment is and how long we've been bullish on the intermediate line, the odds are we'll see here before we'll see up here, because that's just typical. That's typical retracement. And so that's where we say, okay, well, then that whatever system I'm using must not work then. Well, it worked here because intermediate posture was coming up across 50, market sentiment was forming a low point coming up too, so everything is great there. But the problem is we can't go back in time. So we adjust our strategy selection to something that, if we did pull back to here, won't hurt as much, if not at all, depending upon where, what stocks we select and what strategies we use, and, where strike prices may be on different option strategies we employ. I'll bring this back up again. The Russell 2000 already shows a bearish posture. Now, today, it formed a little bit of a hammer pattern. So a long lower shadow there at support, at the 38% Fibonacci support of this previous really strong bullish run. We were kind of trading within this range with 23%. You can see it touching it multiple times. We broke down, touched the 38%. And closed up above the 23% of the intermediate retracement. So we might find, you know, the Russell 2000 might find some support in this area. Otherwise, you still have down to this 38% level, more likely that it will find stronger support. But, you know, and again, you have that long lower shadow just like you did there. For now, if it doesn't, because it's a one-day candle, so we can't trade, we can't expect immediate bounces on one-day candles, hammers, you know, things like that. But what we can expect is say, okay, you know, that's a support level. See how that low point was a support level. We stayed above that low point for quite a while, and then we finally broke it. Well, now we have a new support level, which also happens to be at coincidentally happens to be at Fibonacci support. So if we stay above this for a while, now if we close up above, great. If we close up above this candle, great. You know, closing above the high of the low day. But if we close below that, then we know, okay, next stop 1450, you know, according to the charts. The S&P 500 continues to ride a strong, bullish, long-term trend. We are well up above the 50-day moving average. Obviously, I showed you yesterday how strongly above the 200-day moving average we are. If you take a look at the small cap index, you can see a little different story. We have pulled down to that 50%, so another reason we might find some support here. But if we break that low point, which also happens to be the 50. Again, remember, 1450 is that next area. And then, of course, you have down to the 200-day moving average. You can see the MACD is coming down from a high. You know, kind of, you know, you can see this peak here that produced that drop. This would be a lower high point with a higher high, you know, divergence there. Obviously, a target would be 1350 based on that divergence. So, but we're not going to get to 1350 unless we break the 1450. We're not going to get to 1450 unless we break today's low point. And until it does, because of the support that's there, and the hammer pattern, we expect that it will bounce, at least in the short term. So we'll keep our eyes peeled on that, watching for that support level to know that it's not going to bounce. You take a look at the 3 green arrow chart here, the MACD stochastics moving average, 6-week moving average, and you can see still riding that 8-day moving average. There's an order to pullbacks, and the first one, the first thing we get is a close below the 8-day and starting to testing the 17-day. We're not there yet. Those lines are starting to converge, but remember, they converge very slowly. And again, looking at the Russell 2000, you can see, you know, when we bounce up, we go up sharply. We go up back up to those lines. They won't converge. The MACD won't converge back up. We'll tend to go back up pretty sharply. So definitely want to keep our eyes on the Russell to see how we respond to this hammer tomorrow. Again, the expectations are because of the support that will bounce. It's a bullish pattern. The expectations are will bounce. And how are we going to know if it's not performing as expected? Break below that support level. Here's today's candle intraday range. You see how it fit almost completely in yesterday's range. Yesterday's range was all in the morning. The high was early, the low was early, and then we neutraled out the rest of the day. Today's a different story. The low was early, the high was late. So nice, good. That's a relatively bullish day, getting back up above last week's high point. Still fitting in the range. So it's not completely bullish, but small bullish bias to that because of where that, in fact, the last 10 minutes we got the pullback, and even then, you can see here we actually closed closer to the high, you know, 259.11. So that's a pretty good bullish day. Would be more bullish if we had broken through the new highs, and if we had, you know, we had a slightly higher high here, if we had maybe gapped up a little bit. But regardless of that, it's a neutral candle with more of a bullish bias. We don't want a big range. We don't want a lot of volume. And you can see that we didn't get a lot of volume. 50 million, and today's range was just over a point. So when you look at that from a average perspective, a point's down here, so it's below that line, and 50 million is below the average too, which right now is at 60 million. So you want numbers below these averages to help bring those back down. That doesn't sound right, but that's bullish for a broad market like this. When we go up, we go up. You know, you can see how when we rally, these lines come down. And these lines come down, they're averages. They'll come down when the numbers, the daily numbers, are below those lines and pulling them down. We start getting 80 million, 70 million. We start getting 1.5 point ranges, even if they're bullish days, then that's typically more bearish. That will lead to more of a bearish move and more of a bearish pullback. All right, so the VIX, you can see, is pulling back itself from a much lower high than even really this last kind of intermediate high point. But the question now is, where's the next low point going to be? I mean, for it to get below 9 would be, obviously we just don't, if you go all the way back, as far back as we can go on the VIX, there isn't a whole lot of times that we've ever been below 10, much less below 9. So, that's where the next low point would have to be. It would have to be down below 9. And we talked about before, this monthly typical range, at least on the small end, is about 4 points. And, are we going to get the 7 to get that 4-point range? Or are we going to get to 13, 11, 12 and a half, 13 in that area to get the 4-point range? More likely going to be here sometime, whenever that is. But obviously, it generally it doesn't come, we don't get spikes in volatility. I mean, here we had a good jump off of a much lower low, but usually we'll get a spike in volatility coming off of a higher low point. We usually will stabilize before we'll get that bounce and stabilize in a small range. That's the the paper that the Andrew Thrasher won that Dow. I've referenced that multiple times before. Won the Dow Award from the the CMT Association, Charter Market Technicians Association. So I mean, is this going to be the higher low point that we start to base off of? That's what we want to keep an eye on. If we go to the ratio chart of VIX to VXV, and you can see, okay, well, we would expect volatility to bounce up because the ratio volatility, even though it's not below 75 anymore, is still easily below 80, which is the extreme point. So for it to get back up above 80 is kind of what we need to see on this ratio to stabilize out. And so right now it's still extremely low, and we expect that ratio to bounce. And when this ratio bounces, it typically means the VIX is rising. Now, granted, the VIX can go lower, and today, because you can see it rose, it was actually the 3-month line that rallied, because the VIX actually came down a little bit today, but the VXV rose, so that back month, the longer time frame, rose a little bit, and that's why we see what we saw in the ratio chart. So we want to see to get it stabilized, we want to get that ratio back up in that 85% area, 80 to 85%. Then we can, have some more extended bullish runs and come down from that area into these lower volatilities. When we're already this low, it's hard to stay this low without something happening, because again, it's complacency, and it doesn't take much to get complacency out of the extreme complacency out of the market. One news item here or there, geopolitical, an earning, whatever the case is, can spark volatility just like that. So now we look at this chart here to transition towards what's driving the market today. Now remember, crude oil has been the biggest mover. A lot of that Middle East conflict, tensions rising, but today we got some really dovish, really bearish for crude oil at least, supply data, some really strong supply data coming out of the U.S. production supply, and that push crude oil down a little bit. You can see a little spike in the middle of the day, but still down by the end of the day. And you can see small cap stocks has been lagging behind, along with high yield, so junk bonds. Well, look how, these are your two risk asset classes. And over the last 2 weeks, they're the worst performing. In fact, they're the only two asset classes on this chart, at least, that are down for the 2-week period. You can see the two, up here. We also have emerging markets. Emerging markets are kind of benefiting from this rise in commodity prices. There's a strong link to commodity prices with emerging markets. But you can see large cap stocks way outpacing small cap stocks, and obviously treasuries way outpacing high yield. And those two things, when we take a look at the Russell 2000, which you see is already on a bearish move, and you can see, look at the high yield breaking down too. So we got two, these are the riskiest asset classes in terms of bonds and stocks in the U.S. markets, corporate bonds at least, and they're both showing bearish intermediate postures. The small caps is a little weaker, but this is obviously now below 50. So, we're getting some weakness, even though the broad market itself continues just to produce record closing highs day after day after day. So now just zooming in on just today. Remember yesterday was a risk-off move in terms of asset classes and sectors. Well, look, you can see, aside from this move on emerging markets, you still have gold, international stocks doing well with a small weakness in the dollar, but gold doing very well. Gold is up. Gold has been down because of the strength in the dollar, but gold is up strongly today. And you can see treasuries were down, but high yields are down even more. So a little risk-off, small risk-off relationship there. And of course, gold really whooping up on crude oil. Crude oil is more tied to economic growth expectations down quite a bit. And you can see until this late push at the end of the day, small caps started the day underperforming large caps. This pink line here underperforming. So still a little bit of risk off. Again, even though we get new high, record high, here and there, record closing high at least, it's still a kind of a tenuous situation, which makes sense. I mean, the market sentiment is above 8. It's above 85. The intermediate posture has been bullish for a couple of months. On the near-term line, we just came off of a roughly 20-day run, and we're now at a 9-day run. Usually, after such long extended runs, we get small near-term moves, and we're getting another move. So it's like, we're really kind of long in the tooth in a lot of these areas. So it's not surprising that, to keep things going, we're kind of transitioning into different things here and there. And right now it's the turn for these safe haven areas to lead the market a little bit. There really wasn't a lot of news today. The petroleum report that affected crude oil was really the only thing. And you can see we still got strong economic surprise index up to above 40. But you can see here, so here's those June interest rate hike expectations. It's pretty much a guarantee, I think it's like 96%, that in December we'll get a rate hike. The question is, when's the next one going to be after that? And you can see, so the red line is just the one in December. So the odds of not having another one by June has been dropping, but not today. See how it rose today at the expense of not so much just the one more rate hike, which is this green one, but two more. You can see that's the line that dropped the most. So we've got one priced in for December. The question is how much, and when's the next one going to be? And it looks like there's getting to be a stronger likelihood that we'll get at least one, and the likelihood of two, of like say March and June, dropped today. As we got some of this, the crude oil data, and again because of how overvalued and overbought the stock market is, and how that any kind of impending pullback may impact Fed decisions, which is so weird to think that the Fed may be impacted by what the stock market does, but we know that they are, and right now considering we haven't had a 3% pullback in weeks and weeks and weeks, to get a 5% pullback normally would not be that bad of a thing, but in this environment it could create more bearish sentiment than what would be normal for that type of a pullback, simply because again of how extremely low volatility currently is, how extremely high valuations currently are, and the fact that we've been so bullish for so long that a lot of people don't really know what a 5% pullback feels like anymore. All right, so again, over the last 2 weeks, technology's been the leader, and that took that mantle again today. So that's the kind of the momentum leader right now in the clubhouse. Crude oil has been up there too. Energy stocks have been up there too. They pulled back a little bit today with the pullback in crude oil. Look at real estate. Real estate's taken off, whereas down here, financials have been struggling with the drop in yields. Materials and industrials, which again are economically sensitive sectors, they tend to do well when expectations for economic growth are high. So you remember how we talked about the GDP numbers, and don't take it with a grain of salt, a big asterisk, that a lot of it was a lack of imports and a big increase in inventories. Those are both very temporary factors And so you can see right now the stock market's not really pricing in that economic growth. And there was something I tweeted out too about bond yields. Global bond yields are dropping, even though stock markets are like up 20-30% depending upon the country. And so it's interesting that the bond market's not nearly as bullish on economic growth, which is what it's more tied to, than the stock market is. Stock market is obviously tied to a lot of sentiment, what people think can happen, and whereas the bond market is looking at that economic growth and how likely are they to make payment, all that kind of macro stuff. But it's interesting that divergence, that bond yields are not rising nearly as high as you would expect when you have 20+% gains year over year in a lot of these major developed countries. Finally, you can see again kind of how staples have had a couple of really good days here. In fact, just yesterday and today. So yesterday, remember, was a risk-off day with utilities and staples doing well. Well, just with today, you can see that performance continued. So over the 2 days, staples was down so much. Is really starting to do well. Utilities still holding some of its outperformance, and real estate also holding its outperformance. The other outliers to the downside, financials, again hit by that, by those falling yields, which it's kind of a quandary why they are falling as much as they are and not rising as much as they are. And you can see consumer discretionary and energy stocks down the most. If I just zoom on today, staples and real estate. Utilities, not so much, but you can see, along with they're outpacing technology. So this kind of shows, remember, the correlations of these sectors are from what I've read in some areas, at all-time lows. They tend to get low when the markets are bullish because markets are looking for that next thing to leg this market higher. Because when the market tanks, everything tanks, so everybody buys everything. But when the market's expensive, then we're looking. And we're looking for value here. We're looking for earnings, momentum there. And so right now there was some relative weakness in staples, and that's where the market's looking, as well as real estate. But you still have that momentum leader in technology that has been leading this bullish market and had a good outperforming day today as well. Okay, so for our trade idea today, you can see the stock here, Costco, which is within kind of that consumer staple, kind of retail, grocery retail type sector. Look, it actually got a bearish cluster today. You can see that the intermediate line's up there, the near-term line, the momentum line spiked up, so they're all above 80. But this isn't like a cluster at the end of a month run. Like even over here where you've been bullish for so long, the intermediate line never got below 50. Bullish for so long, you got a cluster over here, and then that led to bearishness. No, this is a cluster at the start of a run, and when you get clusters at the start of a run, especially when they're associated with like a breakout, you can see how we got up to 165, and then today a little bit of a breakout here, breaking not only above that 165 area, above all these highs, but also above the upper Bollinger Band. So there's some opportunity here, but again, are we going to make up to 180? We're going to speculate on a long call, in this environment where the market's so, like I said, long in the tooth across multiple time frames. No, but we do know there's some strong support at this 165 that we just broke out above. If we were to break back down below, then we know that this breakout is more of a fake out. That it's not going to hold. So then we can say, okay, well, let's again, we're not going to say, well, let's use the same strategy here that we'll use when the market's just coming up off lows. No, the market is, we've got to be very careful, and that's why I use these strategies, like selling this put at 165. Now we could probably like sell, buy the 165 call and sell the 170 call against that, and get a pretty decent, a little bit better reward for reward to risk ratio here, closer to 1-to-1. It's not exactly 1-to-1. 250 would be a 1-to-1 reward to risk ratio on a $5 wide spread. So we're not quite there, and of course 170 is only $1 away, and then you'd hit that maximum gain, which would be the $5 minus 215. So that's a little bit more aggressive. If you're looking for a better reward to risk, it's not quite 1-to-1. But in this case, if you sell the 165 put where we know that support is, and then buy a 160 in case there's a big breakdown to the downside, now I'm not getting a 1-to-1 ratio. I'm getting, about that 30% return on risk, which is $1.16. But if I get $1.20, I'm gonna be risking $3.80 to get the $1.20. But I'm also not going to sit and wait. If we break back down here, so here's 165. If we break back down to say 163, then I'm not going to wait for it to to keep on going down to lose the full $382. At 163, knowing that it's broken that 165, which is the support level, then we can take a $100 loss, which is a little bit better reward to risk ratio, with the 118 that we're trying to get. But we have to be, no one's going to force you into that trade. The psychology behind it would be like, oh, it's just a small loss. We'll see if it's a fake out back to the downside. We have to be willing to take small losses, because you notice this line, if we don't and it keeps going down, the losses get bigger and bigger. So now, again, it only takes to move down, and with the purple line above the green, that is now a negative theta trade, which means as time passes, that purple line will come down to the green. And over here, this is a positive theta area, so the purple line will go up towards the green with the positive theta. And you see we're already above. We're already well established in that area where we're currently at. So that's what makes a strategy like this more high probability. It's got decent odds of success, and that doesn't account for the fact that we know there's some strong support at 165 based on the old resistance that we just broke through today. So to summarize, the posture is still strongly bullish. That strong bullish long-term trend is still intact, but it's mature. And the intermediate trend is mature. And the near-term trend is mature. So don't trade the same way today on new positions that you would trade before, when the intermediate posture is just starting to come up above 50. When market sentiment's coming up off of a dip, whether it's at below 70 or below 60 or below 50 or even better. That we're going to be more aggressive and more directional in that kind of environment. But in this environment, we take what we get. The low volatility tells us. I always associate the level of volatility with the level of my return expectations on any new positions I put on today. And with it being really low, then my return expectations are really low, and I adjust. I adjust what strategies I use. I adjust where I'm looking. I'm not as aggressive. I'm not as speculative or directional. I start to get less directional. I start to use smaller trades, and I adjust my returns. And if I get a few percent here or there in a month or two, then that's fine, because that's what the high valuations and the extreme low volatility tell me to expect. I shouldn't expect the same kind of returns that got me to this point, because it's been a strong move to get me to this point. It's hard to maintain unless we have a bubble like the tech bubble in '98 and '99, like the real estate bubble in '05 and '06. And we all know how those ended. If you didn't get out of that bubble, and a lot of those really high momentum trades before they turned south. So thanks again for watching. I really appreciate every night that you watch. I appreciate the likes. I appreciate the comments on YouTube as well as on Twitter. And remember, we've got now close to 600 surveys back on this new business idea that Brandon and I are throwing together. We really, really value your input and your interest level in what we plan on doing. And the best way for us to know that is for you to fill out that survey. Again, remember, it's in the description on this video down below here. Click on that link to the survey. Fill out, it's just 8 questions, but very valuable for us to know what you're thinking, what you want, so that we can deliver that. Again, thank you. Thanks for watching. We'll see you all tomorrow.